Good day, ladies and gentlemen. I hope you're well. So, this session will be a structured market orbit based on chain data, macro liquidity data, no narratives, no emotional conclusions, only what the indicators are measuring and what they have historically applied. Now, we're going to be going through the charts. We'll go through the latest price movements for Bitcoin. We'll look at the Bitcoin dominance. We can't now fully understand Bitcoin dominance without talking about stable coins and stablecoin dominance. We'll also look at altcoin dominance to see what they're doing as well. We'll have a look at some moving averages. We'll have a look at the ETFs. We'll have a look at on-chain data like the MVRV, the Powell multiple, the pi cycle charts. Now, we have covered pi cycle tops. We're going to also be looking at pi cycle bottoms now and just the general health of the market. Could you please share this screen on X? I'm getting banners, and I don't think getting banners that there's a problem with the software and X. I think X has changed the way that they run things. So if you could please share the screen, I would appreciate it. So just very quickly, let's see who's here. So we've already got Mike Volmer. We've got John Legend. We got Muchu. Yeah. I'm gonna butcher your name. We've got Black Hat Team. We should have Rusty Bot in here somewhere. Sorry, the bot which is not coming up live yet, and obviously we've got me in here as well. There are other people watching, so if you are watching, do pop in and say hi. So we will be looking at a lot of on-chain data and metrics, and also some off-chain stuff as well. Let me get rid of that overlay or underlay. So this is we'll probably start off with this. But just quickly, before we do, let me just explain on-chain data. So on-chain indicators are data that comes directly from the blockchain, and they measure what the network is doing and what the markets are actually doing using numbers that come directly from the chain. It's hard data. It's not like headlines. It's not hype news, and it can't be tampered with. On-chain data indicators that we'll be definitely going to be looking for today, or looking at today, is the pi cycle chart. The pi cycle indicator. We will have a look at the tops, but more importantly now, we do need to understand and look at the bottoms and historically how accurate they have been. I've done a lot of work on pi cycle tops, so we'll be looking at bottoms as well today, because we are in a bear market. We will be looking at the MVRV, and that's an on-chain indicator that looks at Bitcoin's market value compared to its realized value, and it identifies how much profit holders of Bitcoins are actually in. We have the Powell multiple, which is another on-chain indicator. It measures whether the miner revenue is unusually high or unusually stressed. It's very important because it can help identify if we are near a top or near a bottom. We will be looking at off-chain data as well. Now, off-chain data is not produced by the blockchain itself. It's external signals that measure liquidity, demand, capital rotation. We'll be looking at things like the ETFs, Bitcoin's dominance. That's a market structure indicator that tracks the share of Bitcoin and the total market, crypto market cap. We'll also be having a look at stablecoin dominance. And we'll also be looking at what everything else, the dominance of the rest of the market, which is very important. And it's just a clean way just to measure capital rotations and whether flows are consolidating into Bitcoin, if they're consolidating or they're going into stable coins, which those stable coins have been around for quite a while. I think 2014-ish. They are massively they have massive adoption now, and it often gives us a clue of where we are in the cycle. There are other things that we can look at depending on whether we have time as well. But just quickly, before anything else, let's have a look at the stock market. Let's have a quick look at the S&P 500 and see what it's doing, because in the short term, yeah, because in the short term, Bitcoin tends to follow. Um, when equities are risk on, Bitcoin usually gets the tailwind. When equities are risk off, Bitcoin usually feels that too. The correlation is not perfect and it does change over time. Now on this, what is it? The 1 hour chart. On the 1 hour chart, the S&P has been moving in a defined range, and it has been doing so for a while. We've got a clear resistance zone up here, and we've got a clear support zone down here. We've tagged support and we've bounced, then we rolled over for a couple of hours. Yeah, this was yesterday. We've only just opened the markets have only just opened before it started to stabilize. So I do expect it to continue to arrange between these two levels. We are getting a bounce on the day. We'll see where that goes. Now, as long as equities are holding this support zone, it reduces the chance of a sudden risk-off flush across the markets. But if it breaks down and it loses this range, you could see a spill into Bitcoin as well. If we have a look at fibs, so we are now zoomed out. I am on the daily, but I'm literally going from a swing high and a swing low and a swing high, measuring the whole cycle. So I'm not looking at what's happening in the next couple of hours, more like the next couple of days, the next couple of weeks. So if we zoom out on this daily chart, we look at the fib levels from the cycle lows to the cycle the cycle highs. These horizontal levels are basically decision zones where the price reacts to during a pullback. Right now, the key thing that we have lost is this level here. We have lost the 0.168 retracement level, and hang on, if I zoom in, where are we now? We have also lost where we've lost the golden pocket, the 0.65 zone. So yeah, we have lost those two zones. Now we could be going down lower. If we do, and we go down to, we could be ranging here for a bit, just underneath the golden pocket, which is something that we do, something that we have done in the past, in between these two zones as well. But if we were to go below that, the next major fib level is the 0.786, and that's roughly around 50. I think it was 57,000 US dollars. Now, if we keep falling and we if we keep falling, the market is basically saying there's a room for a pullback to extend. So the simple reading is either we reclaim the 0.65 or we range or go down depending on momentum, and we could possibly touch upon this level here. Let me get out. Oh, I need to stop sharing the screen for a second. One moment. There's something that I didn't put up. It's the heat map. Okay, so on the okay, I'm gonna leave the heat map for now. The last time I did check it, the last time I checked it, we were pretty much there wasn't too much liquidity above or below. Let's check the fractals next. So if we have a look at the structure of the market. Again, proper zoomed out. We're not looking at what's happening in the next couple of hours. This is a cycle check. We're seeing where the market is going. So we had the double top, the one in April, 64,000 US dollars we had, and we all know, because I keep going on about it, the reasons why we fell, and then we went up and we had this top here, which was the can you guys see it? Yeah. Which was the 69,000 top back in November 2021. We fell into a bear market. Now, this is very important because this is now quarter one of the year after the quarter one of the year after of the bull run year. We're pretty much doing the same. We're following this fractal here. We did follow that and we went down into a deep bear market. Now we've been in this particular trend line since 2023. And this is the fractal that we will be looking at. We went and hit the all-time high like we did before. And then we went down. We actually did break below this trend line from 2023. So this is the fractal that we're looking at. And I need to go back to 2022, the bear market of 2022. Here we go. We've got the all-time high up here in 2021. The all-time high at 69,000 US dollars. Again, we've got the all-time here last year in 2025 at 126,000 US dollars. Then we come to quarter one, we start to go down, and we bounce off this particular trend line 2 or 3 times. We have a fake out, and then we go down, we consolidate for a couple of weeks. Then there's a lot of price momentum going in one direction. We go down, we consolidate. This is actually for around about a month. We tend to see what we kind of are doing the same sort of thing from here. All-time high, we go down. This particular trend line with this fractal, we bounce off it 2 or 3 times. We have the fake out, the rollover. We consolidate here, 19th of Jan to 10 odd days rather than 11th. Rather than the best part of a month, a good couple of weeks, and then the momentum brings us down, and now we've started to consolidate here, just like we did here, which was for about four odd weeks. We've started to do it from like roughly the 5th of February up until now, the 20th of February. We could go for a good, a good couple of days, if not a little bit longer here. And then we might see the same thing if the fractal is not invalidated. We might see that we have a momentum going down, and we went down with momentum. We might see that next. We did go down into the bear market, but this fractal is playing out incredibly well. So we're around about here on the fractal. We'll see what happens. Do expect some sideways action, bearing in mind in the heat map there wasn't anything further up or down. It kind of seemed like it was going to go sideways for a while, and then obviously with the S&P we're just ranging here, if that makes sense. So we could range for a while, and then if we do follow this fractal we might go down again for a bit more. Okay, so we've got the dominance chart. Before we go on to that, let's just have a look at the 200-day, the 200-week SMA. So we did speak last week about the 50-day SMA, which basically means the daily closes over the last 50 days. It's a short to medium trend line, and it's useful for showing momentums and pullbacks, but it's not a main regime trend line. That's more like the 200-day SMA, which is the average prices of the last 200-day, the average closing prices of the largest 200 days, and this is the one, and I'll put it up. This is the one that people look to that generally look to see if it's a bull or a bear regime filter, if that makes sense. If Bitcoin holds above the 200-day SMA, generally the market is considered or treated as bullish and risk on. If it goes below the 200-day SMA, the market is generally treated as bearish and risk off. Now that's the 200-day SMA, and it often becomes the dynamic support in a bull market and resistance in a bear market. This line down here, though, mhm, this blue line, oh, yeah, sorry, I was using my cursor and you guys couldn't see it. I do need to double check. I do need to make sure that, yeah, you guys can see the cursor. Just very quickly, I just want to see the chat. Crypto wealth management. How are you? All's good. Oh my God, look, it's the crypto factor. Hang on. I have to do this. It's Paul from the Crypto Factor. Hello, Paul. I hope you're well. I was talking to Paul the other day. And Chipper's here. Hello, Chipper. I hope you're well. Okay, awesome. Oh, and he's still here. He's so sweet. We'll have him on after Ramadan. For those people who don't know, I am Muslim. I think everybody knows. So I am fasting at the moment, and Paul will definitely come on after Ramadan. I'd love to have him on. He's amazing. And do go follow his channel. I don't know if John Legend can put up his channel. It's literally called The Crypto Factor. Okay, so that's the 200-day SMA. Oh, I haven't actually gone into it. So the 200-day SMA is this blue line down here. It's a moving average. Think of it as Bitcoin's sort of long-term average price over roughly the last 4 years. Now, in a bear market, the price often gets pulled down towards this line. It's a level that a lot of long-term investors watch because in the 2015 bear market, and because we all know the 2013 bull market led into an extended bear market of 2014 and 2015. If you watch the channel, you'll know. And also the 2018 bear market, it acted like the floor. And I'll show you that very, very quickly. 2015. So here we go. It literally pretty much was the floor. That's when it started because it does take 4 years because it is the 200-week moving average. And it literally behaved like, or it acted like the floor. The price did not really go down. It might have wicked down here a couple of times. It might have wicked down there, which I think it has done. But otherwise, that was considered the floor. Then we had obviously 2000 and 2017 bull run, the 2017 bull run. Now, the 2017 bull run, the all-time high was, I think it was in December. I think this was it actually. It touched the floor. Just another thing to mention is that the 2017 bull market ended in December and the bear market ended in December of 2018. Again, it was about a year long, and it literally was the floor of the bear market going into 2019, the recovery year. If we move forward, now here we have the COVID crash. It did wick underneath. The only time where it's not acted as a floor is the 2022 bear market. And we will cover this when we cover Pi cycle top bottoms, which will be later on in the program. The Pi cycle bottom was hit a lot earlier, and then we obviously had the FTX stuff as well. but it was considered. I mean, a lot of it was the floor, or it was just underneath. So, from the say 13th of June, actually, this seems like a long time, to March the next year. Gosh, actually, almost a year. We were underneath the floor. We were underneath this. It's not perfect, but it is where the market tends to stabilize. Now, we've gone below it before. Um, we have gone below it before, and now we've actually gone quite close to it. So we didn't actually touch it on, say, the the 6th of February. Why does that ring a bell? I can't, yeah. We didn't actually go below it on the 6th of February, but we did wick towards it. Basically, right now it tells you that the bear market is actually really quite deep, which is a little bit surprising because in previous bear markets, it's taken us a lot longer to get to this stage. We've kind of seemed to go down, kind of seemed to go down on steroids in this market. Now, what normally happens around the 200 week moving average is that we will tend to floor, or we will tend to bounce above it. Now, if we go below it and we stay below it, it tells you that the market is really heavy and it's going to, or it might act like 2022. So that's the 200-day moving average. Sorry, the 200-week moving average. Let's have a look at Bitcoin dominance. Now, we'll quickly check Bitcoin's dominance. We have broken below this trend line. So we were in this massive, for literally the entire cycle, for almost the entire cycle, we were in this channel making higher highs and higher lows. And then we went up to 66%. We rolled over, and then we broke beneath this important trend line, which has held for, since the bear market of 2022. Yep, since September 2022, we wicked below. Now we've wicked below this, and it's interesting to see what Bitcoin is doing now, especially when you have a look at it with stable coins as well. So mostly we've just been moving sideways. We're chopping in this range rather than trending, and this does tell you one clean thing, that Bitcoin's rotation, or the rotation, is not taking place, i.e., alts are not rotating back into Bitcoin decisively. They are bleeding against Bitcoin, and they have been for pretty much a long time, a very, very long time. They have been bleeding against their Bitcoin pairs. When the Bitcoin dominance is stuck like this, it usually means that the market is waiting for a catalyst, some sort of liquidity to come into the market, bearing in mind we're doing a divergence on the M2, or something macro, or a bigger move in Bitcoin before it commits. So if the money is not rotating into Bitcoin dominant and it's going sideways, it's not even trending, where is the money going? Because it is definitely rotating. We can see that in our portfolios. We have spoken about stable coins before. I actually spent some time talking about them. Okay, so I just spent some time talking about them on a different live stream. But if you look at stablecoin dominance, it tells you this is stablecoin dominance on the 1-day chart. It does tell you that the share of the entire Bitcoin market is sitting, or it is kind of rotating into these cash-like coins. So first, what does dominance mean here? It does not mean the price. That we're on percentages here. It does not mean the price of stablecoins. Stablecoins are normally pegged to the US dollar, or they're backed by something else. The price tends to stay stable. It's market share, and that's basically out of the whole of the Bitcoin, out of the whole of the crypto market, what percentage of the crypto market is in stablecoins. And what you can see, and what this story is very clearly telling us, is that Bitcoin dominance has been rising aggressively. Remember, we topped on the 6th of October 2025, and it has been rising aggressively, 7 or 8%. Now, so when people feel confident, they don't sit in stable coins. They want exposure. They want Bitcoin. They want Ethereum. They want altcoins. They're going to speculate on memes. And it's when uncertainty rises, or when people take profits, or when they're waiting for better entries, that the market starts to park capital in stable coins. It's liquidity moving to the sidelines, if that makes sense. So rising stable coin dominance usually means one of two things. Is happening, and sometimes it can be both. One, the stablecoin market is growing because new capital is coming in, or two, the new money is coming in, but it's not yet ready to take risks, so it's been parked in stable coins. Or two, the rest of the market is shrinking and stable coins are growing because people are selling riskier assets into stable coins. Bearing in mind, if we are in a bear market, and I have been open, we have been in I do think we're in a bear market for some time. People obviously do want to time the bottom as well. So it could be that they're actually waiting for the bear market to get worse before they come in and buy Bitcoin. Not everybody's a Bitcoin maxi, and not everybody will buy Bitcoin at any price, if that makes sense. So either way, it tells you the same thing about the behavior. The market is more cautious, it's more de-risking, and it's more waiting. If stablecoin dominance is rising, it's harder for altcoins to sustain big moves because liquidity is getting pulled back into stablecoins, and we can see it's not acting like the Bitcoin dominance charts, which is pretty much in a range now. It's pretty much in a range. It's just ranging. It's going sideways. It's not doing anything. Stable coins, on the other hand, the stablecoin dominance is rising. Now, this is bullish. This is bullish because, or you can look at this as quite bullish, because with stablecoin dominance, it's also stored buying power. That's dry powder. So when the market finally gets that catalyst, whatever it is, like improved liquidity, rate cuts, or macro risk on shift, or stronger Bitcoin trend, or sideline money, that sideline or this sideline money can be rotated back into Bitcoins and then into altcoins. And then that could be a very explosive move. So as long as stablecoin dominance keeps climbing, this environment is right now is defensive, and it's more selective with its risk. If it starts to roll over, so stablecoins start to roll over after making a peak, and they trend downwards, it's often an early sign that liquidity is being redeployed into the market, if that makes sense. So why this chart matters, it's not just telling you if it's going up or down tomorrow, it's telling you about how the market is currently in a wait and see mode. It's also telling you that rotation in crypto is changing because not everything is going back to Bitcoin. Down here, roundabout this is actually the 6th, on the 6th of October, the stablecoin dominance, or the stablecoin share of the market, was 7.4%. It peaked at around about 15%, and right now it's at 13.64%. That is quite huge. That really, really is. Another thing that we will look at when it comes to dominance is the total crypto market cap. This is excluding Bitcoin and stable coins, because we've already seen them. So this is purely on the risk side, on the other side of the market, because Bitcoin is not considered, or it's considered the least risky um, crypto asset, if that makes sense. And then stable coins are not really considered to be too much of a risk. Now, the trend here has been pretty clear, and it's been pretty clear for a while. The market cap has been stepping down for months. You know, you've got lower highs down here, you've got lower lows all the way down here. And we've got, you know, this sharp leg lower from what is this? You know, the end of January, the 28th of January. Something happened on the 28th of January, and I can't remember what it was. Maybe it was something to do with the Fed. And then so you've got this steep pressure, market pressure going down, dominance going down, but stable coins dominance at the same time, so this is February, is rising, and it's rising a lot. So that's telling you that the rotation is going from altcoins into stable coins rather than Bitcoin. 29th. Yeah, rather than Bitcoin. In fact, money's been coming out of Bitcoin as well and probably moving into stable coins. So it's from both sides. Um, so Bitcoin's dominance is basically going sideways, and that tells you there is a clean rotation back into Bitcoin, but also into stable coins. The market hasn't quite yet picked a lane with Bitcoins because it is sideways action. If it goes up, more money is going back into Bitcoin, and we're going to get this trend up. A trend upwards, and then if it's going down, then it's obviously into altcoins or stable coins. But the stable coin dominance is rising, and that's a very clear signal. Liquidity is just literally parked in stable coins. It means that people are de-risking, taking profits, or waiting for better entries, especially when we're in the bear market. And when you look at everything else on the chart, the total market cap, excluding Bitcoins, excluding stable coins, it is bleeding. So the risk bucket is just getting drained. When you combine all three, it's a clear picture. There's no winner in the rotation. Stablecoin dominance is rising. Liquidity is moving onto the sidelines. Total 3 is falling. Risk appetite is getting squeezed. So the takeaway literally is a lot of capital is rotating out of altcoins into stablecoins, and some of that is going back into Bitcoin as well. This is different to what's been happening in the past. So in the past, with Bitcoin dominance, it's literally been, say, for example, if we go back to 2018, because that was a massive dump. So we had obviously the dominance going down, and then it kind of everything just went straight back into Bitcoin, because although there were stable coins there, they were not really getting used as much. It was slightly different in 2021. Okay, let's have a look at the pi cycle top. We'll use it on here. What's the time? It's 33. Okay, 1 second, let me just check the comments again. Where is everyone? Hi, M Ninja, I hope you're well. Guys, please do follow me on X if you're not already following me on X, and please do repost this live stream. That would be amazing. So we do have, we can go through the pi cycle tops, but because we have done that in the past, let's do something else. Let's actually go through pi cycle bottoms. And we'll check out history first before we okay. We'll go back and see how accurate all of this was in history. Okay, I've not covered it before. Bearing in mind, because I'm in the UK and whoever's done this indicator, it is normally off by a day or two. Um, it is normally off by a day or two. So the pi cycle bottom indicator is perhaps the best bottoming indicator that will tell you pretty much closely if Bitcoin has hit a bottom, and it's absolutely not perfect. But it's based on two moving averages, the 100 and the 150-day moving average, sorry, M estimated. So it's EMA. When that crosses below the 471-day SMA times 0.745, the pi cycle top signals, and Bitcoin may be at or near a bottom, i.e., the low of the market, the bear market. Now, the idea is that the crossover tends to happen during a time where money is capitulating. When the price momentum has weakened enough that long term, it seems like a revision will start to dominate. Now, the indicator pi cycle themed because the moving average Windows multiplier is chosen from that mathematical relationship of that pi number, that pi framework. So here we have the green. Here we have the green. This is the faster 150-day EMA, and the red is the slower 471-day SMA. And the bottoming signal occurs when the green line closes or crosses below the slower red line, if that makes sense. Now, the pi cycle top, if we exclude 2011, there have been three major bull markets. We did go back and we did speak about 2011. There was a top and there was a bottom because Bitcoin hit $1 for the first time, and also it was reported in the mainstream media. For example, Forbes had picked it up as well. And then we had this huge rally that took it all the way up to, I can't remember how far it went up, but it just went up parabolic. And then we had the Mount Gox hack, and then it literally just went down. It had that peak, that proper peak at the top. So if we were excluding 2011, and we have done a live stream on that, there have been three major other bull markets. Now we had November 2013. In 2013, there was two peaks. One was in April, one was in November. The bear market began after the 2013 peak, and it bottomed not in 2014, but in January 2015. We also had, and we'll talk about this. We also had, I think it's we also had the December bull market top in 2017, Bitcoin's second bull run, third if you include 2011. It was in December 2017 that it peaked, and in December 2018, the market bottomed, and the pi cycle indicator was only a couple of days off. Again, it happened pretty much in 2021 and in 2022, where the bear market did bottom. And then obviously we've had the peak in 2025. We'll find out where the pi cycle top bottoms. Now, if we look at 2015, the indicator signaled, I think it was on this chart, it looks to be the 16th. It signaled at the 16th, the price was 100, or the low was $198. Now, the actual bottom was 2 days earlier in 2014, on the 14th of January. So the signal was given on the 16th of January, 2 days earlier. It was the actual bottom at $152. That's a difference of $13 in 2025. So it was exceptionally accurate. And then if we go to 2018, and we have it bottoming here as well. So in 2018, the signal was given on the 16th of December, and the low was 3,178 pounds. The cycle actually bottomed on one day before, on the 15th of December, and the low was 3,122. So that's about what, 54 US dollars difference. It's so close. Okay, now 2022 is where, we had, no, we didn't. So 2022, 2021, 2022, we're actually repeating this fractal here. I always zoom out. When you zoom in, it just looks a bit different. Okay, so this is where it didn't give an accurate bottom, if that makes sense. So around about the 13th or the 12th or 13th of July, we've got around about then it was 18,000. The low was 18,906. If we say that it bottomed here on this particular day, on this particular day, this was the pi cycle bottom. Now in 2022, the pi cycle signaled in January the 13th or the 12th or 13th. However, we didn't bottom. We didn't actually bottom. Can I put up the 200 week? Yeah, that's the 200 week SMA, which normally we floor on this moving average. We didn't do that in 2022. What we had was we had things like the FTX crash that came a little while later, and we actually made a bottom on, I think it was the 21st here. On the 21st of November 2022, the actual bottom was 15,479. So on this particular bear market, I think it was 132 days out. 132 days out, but there was a lot of manipulation here, and one could perhaps argue that obviously FTX, and what happened with FTX, was a black swan event, or the rest of it. Now we have topped, obviously, we've topped in 2020. We've topped recently in here on the 6th of October 2025. We've gone down, we've done this fractal, we've almost touched upon the 200 week moving average here, but we haven't quite. So I do expect we do have more downside this bear market, but this is the pi cycle bottom, if that makes sense. We can go on and look at some other things as well, some other signals that, so like the MVRV. Now the MVRV is an on-chain indicator, meaning it uses real blockchain data. It's not just price charts or external sources or hype, because it's based on actual blockchain activity. The MVRV gives a more accurate picture of market behavior than traditional indicators, because it looks at price trends. The MVRV is basically more of a early warning risk tool, not something that will say, here's the market top or the market bottom, and we're going to flip now. So, what is the MVRV? The MVRV is when holders buy Bitcoin at different times and at different prices. Some holders bought their Bitcoin a long time ago when the price was low, and some bought Bitcoin recently when the price was higher. Now, depending on the price that people have bought Bitcoin, they must or they might be in profit or they might be in loss. And the MVRV ratio tells you how much profit or loss Bitcoin holders are making, and it compares the current price of Bitcoin to the price that each coin was last moved. If the MVRV is unusually high, it means that many holders are in profits. And if it's low, it means that many holders are in loss. And it helps people understand market behavior, whether holders are likely to sell because they're in profit, which they do, at these peaks, or if they're more likely to hodl because they're at loss or they've made a loss. So realized value is every time a coin moves from one address to another address, it's reevaluated regardless of why it's moved, because it is online data. So if somebody moves their coins, yes, that movement reflects as a new true value transactions. But if somebody's just moved coins between their own wallets, the blockchain can't tell the difference. So it still counts as a new cost. In other words, the realized value metric doesn't know why Bitcoin has been moved. It only sees the movement, the movement. So it's very powerful. It's a very powerful on-chain metric and a measure of investors' behavior. It's still an approximate though. So with the score, and this is, I'm very sure this is the MVRV score. That's basically a supercharged version of the regular MVRV score. So why the MVRV will tell you how many people are in profits and loss at a certain time, the Z score goes a step further and it shows you how these profits and loss are compared to historical data. So when the MVRV is high, say above 7 or thereabouts, it means that a lot of people are in profits and they will probably be taking profits, and we're pretty much at a top. When the score is low, when it's below 0, that means that holders are experiencing unusual losses, and that suggests that the market is undervalued and it's a good opportunity to buy. So, in short, the MVRV Z score gives investors and it gives traders a way to see extremes in the market sentiment, helping them identify potential market tops and bottoms more accurately than just the MVRV score itself. So we'll see here again, 20. I hate the way this is written, the American way. So this is 2011. So we had that extreme volatility in 2011, and a lot of people were in losses. Bearing in mind, Bitcoin it shooted up to over 200. It's going to annoy me now. It shooted up to a lot of. Should I find out? No, I'll find out later. And then obviously we had the bear market. We had the bull and bear market. In fact, I think the bull market only lasted 2 or 3 weeks. It went up very quickly. We had 2014 and 2015. This is directly after we had the 2 peaks in 2013, the April peak and then the November peak. Then we went to the 2017. We had the peak again above 7. A lot of people were in a huge amount of profit. The bear market hit, it rolled over. And then in the bear market of late 2000, and the reason why it says 2018 and then it goes straight to 2019 is because the peak actually happened for the bear market top in December 2017. A year later, December 2018 was a bear market bottom, and that kind of shifted into 2019. So that's why you have pretty much it's in the bear market in 2019 as well. This is 2021. This is the beginning of 2021. This is the first peak of 2021 in April 2021. It just about hit it, or it was just ever so slightly off the 7, ever so slightly off the 7. I can't even get it to go close, but it was just ever off, slightly off the 7, but it's pretty much there. We rolled over. Remember what we said about the December, um, sorry, the second peak of Bitcoin in November 2021, that it was mainly not driven by Bitcoin dominance. It was mainly driven by other things, by hype and rotation, etc. The second peak, some people still consider it as a Bitcoin, sorry, a dead cat bounce. The pi cycle top was not even hit. Then we went down into the bear market, and here we can see that it went under 0 again, and it stayed under 0 for pretty much a while. If we zoom in here, so we had the top, and then now we're going down to literally pretty much 0. So that would be a really good time to buy. Do we wait for this to go to 0? You don't have to. You can DCA in. I think the best way to buy Bitcoin is to DCA in. We have some time to have a look at the Powell multiple. So the Powell multiple, which is, what else have I got? Oh, the fear and greed index. Yeah, so the fear and greed index currently is sitting at 9. So here we had, say this is 2021, we had the peak. It went up to 70 or thereabouts, 70. And when we had the other peak in 2021, the first peak, April 2021, again 78. It went up quite high. Over here, it went up to round about 70 as well. So we had the all-time high when the fear and greed was quite high. It was in the 70s, and historically, that's what it's been in the past as well for the peaks. But when we come down, we do get, I mean, it takes us months to get into the single digits. And here, here, I don't know when it is. So on this is January, February, March, April, May, June. In June, we peaked in November, and in June we went down to a fear and greed index of 6. Right now, we have a fear and greed index in the single digits, and we're in February, and we topped in October, November, December, January, February. So 5 months. So we're going through this quite fast. Should we talk about the Powell multiple? It's pretty much coming up to an hour. We'll leave the Powell multiple for next week. Sorry, not next week, the week after. So Monday, we've got on the channel, Monday, we've got Bill Noble back. We may have Formation joining us as well, and we will be discussing AI in crypto. We might be going through some charts as well, and the AI narrative and how it's literally going to change the entire world, because that matters a lot with what's happening in real life as well. So that's on Monday. On Thursday, I probably won't be doing a live stream. If I do a live stream, it will be on either a Wednesday or a Friday. We're going to be having a crypto story. We're starting up the crypto stories again. This time we're going to be having Nick, who is the CEO of Coin Bureau. He's going to be telling his crypto story. He'll be going through his crypto journey on the channel. And, the Coin Bureau is absolutely massive. It's the largest crypto channel in the world. So I'm really looking forward to his story. And then, yeah. Oh, look, John Legend's happy. Oh, I'm happy with you. And then we've got Yeah, we'll have so if I do go live next week, it will probably actually be on the Friday, and we can talk about, some other things, maybe some macro things, or go through some TA. Anyway, thank you so much for joining today, and I will see you all on Monday. And yeah, do feel free to post